If you're new to investing in the stock market, it can feel very intimidating. If it feels easy to you, I'd be concerned about you. So the fact that you're intimidated is a good sign. It's a time to take a step back and wait. Here's the good news. Where we stand today, and I'm recording this video on November 8th, 2022, the stock market is extremely overpriced. So jumping in immediately is not going to be a lot of fun. What I suggest you do is still stick to buying low-cost ETFs on a regular basis, dollar cost averaging. But if you're looking at buying individual stocks, this is a very, very important video that you need to watch. And if you like the video, what I need you to do is subscribe to the channel because we do several videos per day. We have over 1,800 videos in our history. So it's a good way to learn about individual investing. So what is buying a stock? Very simply, you're buying a piece of a business. You need to understand that first and foremost. You're not buying a ticker that's going up and down. You're buying a piece of a business. And here's the proof, as Charlie Munger says. If a company goes under, goes bankrupt, and you own a piece of stock, you will be paid out based on the liquidation value of the entire business and paying off all the debts. That is proof right there that you're buying a piece of a business. That's exactly what is going on. As the company generates cash flow, it's going to stack money in its accounts, and you have a piece of that cash flow. You have a piece of that money in that account. So if you pay a reasonable price for the business today, and I'll get into that in a little bit, but if you pay a reasonable price today for that business, and that cash flow increases over time, you will probably make some sort of return based on that cash flow. So let's say, for example, that the company is cash flowing $10 a year starting today, and you pay a reasonable price for that. In 10 years, if it's generating $20 per year in cash flow, the business has probably doubled in value for you, and the stock should do so as well because you are buying a piece of that business, and as the business's revenue, profit, and cash flow increase, so should your stock price. So what causes the stock price to go up or down? Well, every value investor, Ben Graham started saying this, and Warren Buffett made it very famous by saying, in the short run, stocks are a voting machine, and in the long run, they're a weighing machine. So what does that mean? Well, in the short run, stocks can be very popular or very unpopular. Let me bring up an example. This has been talked about a lot lately. Carvana. Look at Carvana stock. It is down 7% today. Look at the 5-year chart. In the short run, it's a voting machine. In the long run, it's probably a weighing machine. Now, this is 2018 to now. It's not a very, very long run, but the point is, you look at this and go, okay, well, let's see what the stock's made in the last 5 years since going public. Well, guess what, guys? Bad, worse, okay, bad, 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 really bad. So it makes sense. In the long run, what mattered was how it's doing here. In the short run, it was a popularity contest. And in the last year and a half, the all-time high was $376 on August 9th of 2021. That was 15 months ago. It was at $377. This is not a typo. It is at $7 today. So leading up to August of 2021, it was a really popular stock. It had a lot of momentum, going crazy. The car business was huge. People were paying through the nose for cars. And since then, it is down 98%. In the short run, it's a very unpopular stock. Now, does that mean it's a good buy today? I don't know. But the point to see is, fundamentally, if you buy a good fundamental company, it should not drop 97, 98% in a 1.5 year period. And if it does, you better take a deep look at it to either understand if you're wrong or if you can make a major, major investment at that point, because this is a huge drop. Now, for other companies, again, the short run drives things. Look at cannabis. Look at real estate in the 2000s. Look at tech in 2000, early 2000. Look at electric vehicles in the last year or 2, 3 years. In the short run, they're a voting machine. In the long run, we will see what happens. Look at what happened with Intel, Cisco, Micron, all these major companies back in 2000. Cisco and Intel, their revenue and profit have over doubled in the last 22 years since 2000. Their stock has not equated their 2000 price yet. Think about that for a second. They are still below their stock price in 2000, even though the revenue and profits over double. Look at Intel right now. It's at $28 a share. Back in 2000, it was at $74 a share. All-time high was August 27th, 2000 at $75 a share. And we have this all in our software because I want people to see this kind of stuff. This to me is important. And since then, it has never crossed that line, even though revenue and profit are over double what it was 22 years ago. Cisco is the exact same way. Just think about that, guys. This is what's important for everybody to understand about investing. That what drives companies in the long run are the fundamentals. If you pay a reasonable price and the fundamentals get better, you will do very, very well in the long run. Now, back in 2000, I was exactly the same as you. I didn't really learn about value investing and really truly understand it. It took me 10 years. Now, does that mean that it's going to take you 10 years? No, because I was alone in my journey. I didn't have YouTube and somebody to explain this to me. Things made sense. So if this sounds daunting to you, do not worry. It's still daunting for me to this day. It's a lot less daunting, but it took repetition and understanding. And that is very, very possible for you. You can absolutely do it. If what I've said to you so far makes sense, you're way further along than I was back in the day. Way further along. And guess what? You're further along than Warren Buffett was when he started his journey in his 20s. He had to wait and realize this through Ben Graham and go, wait a second, this makes sense. So if you already sit here and say, boy, this actually makes sense, two things I want you to do. Subscribe to the channel and keep listening and understanding. And don't stop learning because it might feel daunting, but it is not. It is very simple. In fact, investing is one of the few things in the world where the simpler it is, the better you'll do. So when I say if you pay a reasonable price, what does that mean? Well, in very simple form, do you believe it's possible to overpay for a good thing? If you believe that's possible, this is the channel for you. And the reason being is I don't disagree that you should overpay for something that's growing. I absolutely 100% agree. In fact, in our stock analyzer tool in our software, the very first line is revenue growth when trying to determine the price of a company. Growth is the most important part of value investing. And you might sit there and say, wait a second, that doesn't make sense. Yes, it does. The point is somebody mispricing growth? And usually when a lot of growth is happening, it's exciting, we all love it, and we bid up the price, but it gets to nosebleed levels. And my whole point about everything is it's possible to overpay for growth. If you believe it's possible to overpay for growth, you're a value investor in some fashion. You still have a lot to learn, just like I did, but I remember back in the day thinking to myself, well, yeah, it's a good thing, but if everybody thinks it's a good thing, the price is going to go sky high. And that's what's called being a second level thinker in investing. The first level thinker thinks, that's awesome, I got to buy it. The second level thinker will say, wait a second, that's awesome, and everybody's going to want to buy it because of that, so therefore probably the price will be too high for me. That's the goal when you're being a value investor, is to find times in the market when things are tough and mispriced and to buy it then. It's easiest to do when the market overall is down. It's harder to do when the entire market's up and this one stock is down. That's the hard part. So the appropriate thing to do is to use something like a stock analyzer tool and make your assumptions about the future, the growth rate, the profit margin, the free cash flow margin, and it'll tell you what price to pay. If you believe you can overpay for growth, you're going to do very well in investing. It could be scary out there still because everybody's going to be making a lot of money, your neighbor, your neighbor's kid. But in the long run, that is what matters, is not overpaying for growth. What's key is to understand this. The more you pay for something, the less your return. Think about it this way. The future is unknown, but in and of itself, what's going to happen in the future is going to happen no matter what you pay for the stock. The company doesn't care what you pay for the stock. If you pay $10 a share or $100 a share, how is that affecting all the workers in the company? They're going to go work the company. They're going to keep doing things. And if the future cash flow of the business is $2, $3, $5, $8, and $20 a share, guess what? If you pay $10, you're going to get this. If you paid $100, you're going to get this. Which would you rather do? The more you pay for the company, 100 to 10, the less your return is going to be. Because this is $5, $10, $18, and $38 in profit. Would you rather pay $10 for 38 bucks or $100 for $38? That's the question you need to ask yourself. And that's the point of the future, separating the price from the company. You have to be able to sit there and determine, I love the company versus I love the stock. That's the difference. And price and value are where you have to sit there and figure out, is the value of this company greater than the price the market currently is giving? Because Mr. Market, as Ben Graham talks about, is going to wake up every single day and he's going to say, I'm going to buy shares from you, or I'm going to sell shares to you based on this. You have to decide if Mr. Market's being rational or irrational. The key is you want him to be irrational on the downside. You want him to sell you a company at a price much cheaper than the long-term value of the business. But it's hard. Why? Because every day that market's going up and down, up and down, up and down. And you can get caught up in it. And I get that. I have the same thing happen to me. I own Alibaba and Meta, and I have a play on them. Could I be right or wrong? I don't know. And it's hard to see those stocks fall. But if I believe in my thesis and I believe in the future of those two companies, my goal is that in the long run, the profit will rise to the top and people will pay an appropriate amount for the company. And this has happened time and time again for decades and in fact, centuries. We just didn't see it on a grand scale as we do today because of social media, things like that. So if this makes sense to you, I urge you, please subscribe, stay with us, because we go into greater detail in so many other videos, and we do 2 or 3 videos a day. You will not be lost for content. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?